Hi, this is Adam Carlini with Dynamic Wealth Management. Today behind the camera is Grant Haddon and Gary Luna, our other partners. And this is our November 6th market update. And we'll be doing our subsequent one will be in December, the beginning of December and the beginning of each month. So it's my turn, and I'm excited there's a lot going on. So I'm excited to have this opportunity to talk to you about our views in the market, what our portfolios are doing, how we're allocated. A lot of news, a lot of things happening with elections, concerns with the spike in COVID. So lots of stuff to cover. So we'll get right to it. So first off, if you're thinking about what's going to happen with this stock market with the election coming up, the common wisdom was this. If Donald Trump wins, he'll probably challenge the results. I'm sorry. If Donald Trump wins, maybe because of the unrest and the people that were wanting Biden and his philosophies, the Democratic philosophies and platform, they would be upset. Maybe they would riot. Maybe we'd have vote counting going on. On the other hand, if Biden won, then Trump already told us that he would challenge. So really the only way that wasn't going to happen is if we had a landslide victory for one or the other, right? A landslide would kind of give a mandate to the victor. So that's the common wisdom. We didn't get a landslide. In fact, it was neck and neck down to the final bit. And even now we're having to recount because it looks like there's some shady stuff going on. We'll see how that all turns out. So that being the case, what was supposed to happen in the stock market with an unclear winner and with vote challenges? That means more uncertainty. Stock market hates uncertainty. That was where the stock market is supposed to go down and down. Well, what actually happened? Well, I'll get to it in a second. Let's just review where we've been. This year we've had coronavirus actually started back before this, but it didn't seem to matter until it did, and then we had the big drop. Then we managed to move out of that and finally break our way back to even and even make a little profit. And then it pulled back, then back up again, and now we've had this pullback just before the election. Why? Again, the concern about what might happen if there's not a clear winner. And even if there is a winner, challenges and uncertainty. So the uncertainty resulted in a market giving back those gains. And here we were down here a couple of days before the election, and basically where the market started the year, so about zero, and in fact in the Dow Jones Industrial Average negative for the year, and maybe slightly negative here as well in the S&P 500. So we get our results. What happens? Unclear. Market's supposed to drop, and that happens, right? Boom, boom, boom. All up. In fact, over a 5% rally in the last few days. Today it was kind of break even, slight loss. Okay, why? How could that happen? I thought uncertainty was so bad. Well, the key is that there is some certainty, and that actually the presidential race may not have been the most important as far as the stock market is concerned, because you have the Congress and the president, which are checks and balances of one another. If we had gotten a blue wave and we had a victory for the Democrats and they had retaken the majority in the Senate, they already had the majority in the House, plus a Democratic president, then that would mean undoing the tax breaks that Trump had given and his focus on the stock market. And likely the other changes, more stimulus, would have been good for the stock market in the short run, but probably bad in the long run. They've already spent a ton, way more than they spent on QE 1, 2, 3, and 4, which is really what's helped break us out of this malaise down here and make the market rally. But maybe we've had too much at this point. So that was the thinking. Now, instead, we got Congress lost seats in the House, and they didn't get the takeover of the Senate. And so even if Biden is found to be the winner, we've got gridlock. Because he no longer, even though the Democrats are still controlling the House, they're doing it by a smaller majority. That was opposite of a mandate. And the Democrats in the Senate did not succeed in flipping the seats. Now, it's still up for bid, right? They still could, depending on the results. But with the four states, basically North Carolina, Alaska, and two senators from Georgia. Three of those four, with a majority of the votes cast, look like done deals for the Republicans. So it's likely that this 48 becomes 51, maybe even 52. So, and one of those elections will be a runoff in January. So, bottom line is, with that gridlock, it's good for the markets. Well, what if Trump wins? Well, if Trump wins and he has this Republican majority, he still doesn't have the majority in the House. So between those two, we've got gridlock. So regardless of who wins, Trump or Biden, we have gridlock caused by a division in Congress, and that means they can't ramrod through their policies, and therefore less change means more certainty that the market continues to move forward and go up. Plus, where else are you going to put your money? Interest rates are so low in bonds that they're just not even attractive. And if we start to see more inflation because the Federal Reserve has decided to kind of take a hands-off approach, then that means higher interest rates, which we actually have seen happen more recently. So the market's the place to be. And which market is the best? Well, the NASDAQ 100, and here's just the NASDAQ. NASDAQ was already doing great. So look, they had their COVID struggle, but then they got above it way earlier, and they've been making profit ever since. And then when they ran up here, they ran up big, 9% instead of 5%. And part of that is because if the Democrats had won, there was a threat to break up the big techs. Well, that threat is now no longer a threat, and therefore the big techs moved nicely higher, and so we got a nice rally here. Incidentally, the NASDAQ has been an area of focus for us in our core models and our model portfolios. And so that has benefited us this year, because look at this NASDAQ, up 39% for the year. The S&P 500 only up 10, but up at least. The Dow has been non-existent, barely made anything. Small caps just recently started to bounce back a bit. But international, having money overseas is even worse. Lost money so far this year. Thankfully, we have felt that the strength was in the U.S., and so we have no international holdings right now. And so we've benefited by having most of our money between the NASDAQ and the S&P 500. That's where our core models have been, and also our sector model. That's where the bulk of the money has been in our growth leaders and our 20 stock model. So we like those areas. They've been good to us. We think they'll continue to be, and that's where the strength has been. Dollar's been weak, commodities weak because oil's been terrible, but gold has been a bright spot and has been popping up lately. So looking at how we're allocated then, in our sector rotation model, remember that we take, we take out of the 17 different sectors that we've subdivided the S&P 500 into, we only want 8. So we want to get rid of the worst ones. So we first exclude those that are trading below their 6-month moving average. That got rid of healthcare, biotech, and energy. Then we look at the remaining and we rank them based on volatility using a proprietary method. That determined that the other ones here in red all didn't qualify. So we did have enough that could qualify. So we have 8 positions, home builders being our top one, consumer discretionary next, followed by materials. That also benefits with the home builders, and also with both the Democrats and Republicans talking about infrastructure and spending money there. That helps the materials. Utilities for safety, gold, as I mentioned, picking up with a weaker dollar, potential for inflation, uncertainty. Retail, because we're getting closer to Christmas, and the semiconductors, because we don't have a breakup of them. Consumer staples, a safe place to be. Our risk indicator is still indicating a positive market, so we're bullish. Therefore, our models are still bullish. That means they're still risk on. That means in our growth model, 100% invested. Moderate model, 80%. Conservative, 60%. So the other 40% over here in the conservative and 20% is in treasuries. And we'll keep it that way until our model tells us it's time to go neutral. So things look positive. We expect the market to continue to move up, although it had a pretty sharp move recently. Maybe it pauses a bit. Maybe it digests some of those gains. But it's looking pretty positive regardless of who wins the presidency. So we look forward to seeing you again in our office. And until COVID stops, we'll continue to do these by video. So thank you for being with us. We appreciate your support and your confidence. See you next time.